So Chris, thank you very much for joining us today. Perhaps you can start by introducing yourself and giving us a bit of background about yourself.
Absolutely. Thank you, Ian. Fantastic introduction there. You've obviously done that before. Thank you all for attending first and foremost and taking the time out of your day. If we do have any technical issues, I'm actually working from home today, but often is the case, just press the refresh button or put your hand up, okay? So fingers crossed we don't have any technical issues today, but just that I'd point that out at the start. So as Ian alluded to, my name is Chris Saunders. I'm a chartered wealth manager and have been chartered now for the past sort of 15 or 16 years. At New Horizon Asset Management, essentially we work with financial advisors in allowing them or enabling them to build their own in-house model portfolio service. So essentially we're in the background. You don't often see me, which is probably a good thing. We're in the background creating portfolios, advising portfolios and analysing portfolios and ensuring that things such as cost, diversification, transparency and liquidity, of course, is all in line with the client's risk profile. So that's what I do, and that's what I've been doing for almost the past 20 years. And I'm very, very pleased to say we enjoy working with Abbey very, very much. So that's a little bit of background on myself. Ian, would you like? Do you have any sort of questions?
No, Chris,
like to kick off with? You said you could
enjoy
me today, so I'm a bit nervous.
We enjoy working with you as well. So I guess the question, on everyone's lips, certainly when they go shopping, have we turned the corner with inflation? What's happening?
What's happening? That's a good question, actually, what's happening. And it's been difficult to understand what is happening over the last sort of 18 to 24 months, because in many respects, we're in our uncharted territory. And we're in uncharted territory because, of course, following the pandemic, there were always going to be these fallouts. And one of the fallouts, of course, is sky-high inflation. If we go to one of the slides that we have there, Ian, when you have a moment there, the one thing about inflation is that is all we have been talking about over the past 18 to 24 months, and probably you're all bored of it. You're certainly all being affected by it. Now, what has happened in 2023 is that we're speaking less about it. There's almost been this sort of narrative shift, if you like, or in many respects, there's been narrative changes every week. So if we move down onto the first slide there, please, Ian. I've written down all of the narrative changes in the first 5 months of this year. And quite frankly, this doesn't even include Ukraine. There's still a war going on, okay, and a number of other sort of important sort of narratives or issues that we've had to deal with. So starting in 2023, we initially had to deal with what is called the US hard landing. So everybody was then moving on from inflation right into the recession. So that was the buzzword, recession rather than inflation. Then it was felt, of course, a couple of weeks later, that, of course, it's going to be a US soft landing. Well, what does that mean? It means the US is actually going to avoid a recession. Then the sort of newspapers were hitting the fact that there was going to be no landing and actually an acceleration. We've then had in the background a China reopening, again, consumption boom. Somebody, I think, may have to turn themselves on mute there, guys. I think someone's doing some home removals. We then moved on to sort of a China slowdown and disinflationary balance sheet recession. Then an inflation boom in Germany and Europe. We've had to worry about that. Recession in Germany and Europe. Then the Fed was going to cut interest rates in July. Now the Fed's going to cut or hike interest rates in July. And actually, we're pricing in a 25 basis points increase in June. Then, of course, we had the regional banking crisis when a number of regional banks in the US went bust. So a lot of the newspapers were then writing about, of course, there's the end of the US hegemony. So the end of the US dollar to be taken over by the renminbi. Now, none of these narratives actually have to be true. They don't actually have to make sense. But what they do, they move markets. And that's what we've experienced this year, is that we've had this sort of volatility. So OPEC, production cuts, nervousness then, oil is going to take us back through highs. That's, of course, going to affect inflation. Then, of course, the narrative is OPEC doesn't matter any longer. They've lost control of the market. Now, yesterday, just to let you know, the Saudi Arabians have cut oil production again. What happened to oil? Oil spiked. Then, of course, we've had the game of chicken with the debt ceiling crisis between Biden and McCarthy. That's now been resolved. And of course, we're now at the juncture, AI, artificial intelligence, will save or it will kill us. So without actually answering your question whether we've turned the corner on inflation, which I'll come on to in greater depth in a moment, everybody's almost moved on. There's a narrative change every week. So, it's difficult for central bankers, let alone investment managers, to understand exactly where inflation is going, but also to understand how we should position. And how we are to position is diversification. So look, if I actually answer your question now, I'll try my best. Let's move on to the second slide, please, Ian. And let's see if I can give you sort of greater understanding. Look, second one, that's perfect, yeah. I'll come on to this chart in greater depth in a moment, okay? But to give you background, inflation is high right across the globe, okay? It remains high. Food price inflation in particular is double digits across the globe. So this gives further credence that there's greedflation. So many of you might have been reading this in the newspaper, greedflation, when actually supermarkets, for instance, in the food industry are keeping prices high and extending margins. And if you look at, for instance, US earnings, which is when companies come to market and demonstrate how much they're making money, what their profit margins are as high as ever, in some instances higher. You look at the UK, we'll focus on first. Core inflation, 6.2% in April. That's the highest since 1992, February 92, right? So we're going over 30 years. Headline index increased to 8.7% versus 10.1%. So even though inflation is coming down, it's still 9%. This is pretty big stuff. Food inflation in the UK, believe it or not, is currently at 15%. Okay, so this is quite frightening. Now, in Europe, which I know a lot of Abbey's clients will be based, agricultural and energy prices are coming down. Okay, so that's a positive thing for inflation coming down as well. Okay, but again, food inflation figures, despite sort of Spanish figures coming down more than expected, are still raised. They're still very high. Moving across the pond, the US Federal Reserve's preferred inflation measure, which is the core personal assumption expenditure, that increased by 0.4% between March and April. Again, that's ahead of the anticipated 0.3%. So the picture is still mixed. Data is demonstrating inflation is coming down, but it's still very, very high. Emerging markets, which I won't dwell on, is actually, if you look at China, inflation is coming down considerably there. But again, emerging markets we have less exposure to if you're a client living in the UK or, of course, in Europe. Okay, so I won't focus too much on that. This particular chart, though, demonstrates what is priced in. So what are we to expect? Given the persistence, when I say priced in, I'm talking about interest rates. Okay, so we're always trying to guess as an investment manager where inflation is going, and then of course where interest rates are going, because that dictates how we position ourselves. If we look at this particular chart, June 2023 on the left-hand side here would indicate that due to the persistence of food price inflationary pressures, central banks are expected to keep a tight rein on monetary policy. So we're pricing in, and traders in general are pricing in, a further 0.25% increase in June. Okay, so that's another 25 basis points. Now, as you can see, if you go on this particular sort of, this essentially is a survey sort of analysing, if you like, sort of traders' responses on, global traders on where they think interest rates will go. Well, it's being priced in that we'll eventually receive a cut in US interest rates by the end of the year, in December. I'm not saying that's going to happen, but that would point to inflation has peaked and inflation is coming down. Okay, so that's the data side of things. If we go on to the next slide, please, Ian. Now, I'm at risk of boring you now, okay? I mean, I was always at risk of boring you anyway, Ian, okay? But I'm really at risk of boring you now, because if we delve further into inflation, just to give you an idea of what people are looking at. So we've talked about data.
Supplied by the widow, the death certificate issued in Colombia, and the death notice provided by the French embassy.
Sorry, Chris, you're on mute. Chris, you're on mute. Sorry.
Somebody put me on mute then.
All right, sorry about that. Start again on this slide. That was my fault. We had a bit of background noise.
No problem at all. Okay, I mean, it's like the old hook, you know. It's the power you have there. So the data is what we've touched upon, right? So everybody reads these sort of, these percentage changes every month in the newspaper. You know, what does it really mean? I mean, essentially it means, is it going up or down? All right, you know, that's what the data points to. Is inflation going up or is inflation going down? And there's lots of different measures, okay? One of the things you may have read about when analysing inflation is the focus on the labour market. Now, this is enormous. This is really what has been the sort of main problem in the US, because the labour market has been really stubborn and it's been really noisy. But why is the labour market important? The labour market is important because if you have a hot labour market or a tight labour market where there's not many jobs, there's competition for jobs and there's a high employment rate, that means there will be wage inflation. Because if there's less jobs, more people are going after them, wages go up. Simple stuff. Now, there's a measure in the US called the non-farm payrolls. Now, please, I told you I was going to bore you on this, but this is probably something you read about every month because they come out every month and they're studied by everybody across the globe when looking at interest rates, when looking at employment. Now, this is essentially a measure of how many jobs are created month on month. So how many people enter the workforce? So this is what this chart is essentially here, okay? So this chart demonstrates from 1993 to 2023.
Where's the time?
And I think someone's not on mute there, that doesn't matter. So this chart essentially demonstrates in periods of when there's not a recession, you will always see jobs increasing. You will always see jobs or new job creation month on month. The only sort of caveat to that, of course, is in 2001, which is where we see these this minus 200 and this minus 400, and of course in 2009. 2001 was a recession, 2009 was the global financial crisis. So you're, of course, in a recession, you're not adding jobs, you're reducing jobs. So we've taken out 2020 here, which is the pandemic, which completely sort of renders this particular chart useless if you have the pandemic in this. We've taken that out. So if you focus on 2022 onwards, which is the spikes here on the right-hand side, the jobs market, the labour market is still strong, it's still tight, which is pointing to inflation. But what is demonstrating clearly is that the amount of jobs that are adding are actually falling. Okay, so month on month, even though we're still adding jobs since the start of 2022, the amount of jobs is falling, which demonstrates again, and this is a big sort of indicator of inflation, that inflation should weaken. If we go on to the next slide, Ian, you did ask me about inflation. I'll finish off on this one, but I think this is an interesting one. Look at the employment rate, right? So on the left-hand side, this is the employment population ratio of 25-year-olds to 54-year-olds. So currently over 80% of those in workable age are employed, right? That's high. That's as high as it has been since the turn of the century almost. So that's pretty high. That would point to wage inflation, increased inflation, right? That's the first thing, okay? But that is not true for the population as a whole. So work with me on this one, guys. The second chart here, okay, this is the total population ratio. So the total population ratio includes those older than 54, essentially. And that when you look at this particular figure, just 60% of the total population are in work. Now, why is that important? This is a reflection of demographics. Okay, because the employment rate overall is steadily falling. What does that mean? Well, because
does that go up to retirement age then? I mean, it
doesn't. Yeah, exactly. Yeah. So it will include exactly. But the important thing here, Ian, is that because we have retiring baby boomers coming out of the marketplace, there are proportionately more older people in the US and are seeking earlier retirement, for instance. So what this then means is that an aging population is a serious issue long term, and we've seen this in Japan. So if anything, this is disinflationary. So even though we've got absorbed in these 2 years of inflation, the bottom line is demographics in the US, and it's a similar story in developed world markets, because most of the developed markets have aging populations like Japan, that actually the percentage is going down. That is disinflationary. So what I'm trying to say to you is that this spike of inflation we may look back on, because ahead, you go back to 2019, 2020, ahead before the pandemic, the nervousness was over deflation, if you remember, not inflation. Now, if you couple this with AI, artificial intelligence, now that's something we'll come on to in greater depth. If anything, we're in a disinflationary market long term, one might argue. Now, look, that's for another day, but I'm just trying to give you coverage, what to look at: wage increases, wage inflation, labour market, the data. I don't expect you to study it, but keep an eye on, and hopefully it gives you understanding when you're reading these things in the newspaper. Because sometimes I'm reading the newspaper and going, what does that actually mean? You've got to take a dictionary out sometimes, certainly if you read the financial sort of part of it. So just to give you an idea what to keep an eye on. Hopefully that wasn't too boring, Ian, and hopefully I covered no inflation.
No, perfect. Yeah, no.
You'll
no,
never
perfect.
ask me again.
Thank you.
I suppose the sort of the big thing that we mentioned this 10 minutes prior to the meeting today is, if inflation isn't a buzzword, I suppose the new buzzword is recession. And we don't really want to shout that out too loud, because nobody likes a recession, but I think that's probably where we're at the moment. If we go to the next slide, which would be helpful. Thank you. Thank you, Ian. So I'm going to try and sort of discuss, what a recession might look like, because a recession was definitely on the cards in Europe, in the US, in the UK. It was going to happen. But essentially what we want is a Goldilocks economy. So Goldilocks there is on the left-hand side. Okay, now Goldilocks at the moment is really important in my life, because first of all, I've been reading about Goldilocks since the global financial crisis, because Goldilocks is when an economy is not too hot and not too cold. So there's this tightrope the central bankers are constantly trying to maneuver to ensure that the economy doesn't overboil, but it doesn't undercook. It's pretty difficult. And that's pretty difficult, especially, and this is on the left-hand side, is that, and I'm focused on the US, but it's a similar story across the globe, certainly in developed world. We've experienced in the US, which kind of dictates how the rest of the market goes, the economy goes, we've experienced 9 interest rate rises in less than 15 months. That is unprecedented. Okay? We have gone from a base rate of 0.25 to today 5% to 5.25. Unprecedented. That is enormous. There is no wonder we are expecting a recession, or we were expecting a recession, and unfortunately not a Goldilocks economy. What is pretty incredible, against this backdrop, okay, if you look at the UK or Europe firstly, against this backdrop, which is increasing interest rates, it appears that with a fall in energy prices and better than expected data, we're going to avoid a recession in Europe, which is very, very surprising. If you go back 3 or 6 months, okay, that's pretty big stuff. Now, why has that happened? Well, energy prices, I think everyone was pricing in, further pressure from Russia and whatnot. That has gone away to an extent, okay? Consumers also have managed to draw upon their savings that they built up during the pandemic. And in Europe, UK, that's still been apparent. So that has helped consumers throughout this period. In the US, however, savings have been depleted. And a recession has been seen as almost acceptable as the sort of Fed has looked to reduce this wage inflation that we spoke about earlier. So kind of everybody's kind of gone, well, the Federal Reserve has stated, well, look, we'll do what it takes to break this inflationary period. So that means we'll do what it takes. We'll take a recession on the chin. What has actually happened, believe it or not, and if you look at gross domestic product, which is a GDP, which is a traditional measure for economic activity, we're not in recession, and it remains positive. Now, we have to keep an eye on this, and I'm going to say this out loud now, and I'm probably going to get shot the next time we speak, but what feels to us, what is feeling at the moment, is that actually we're going to avoid a recession in the US as well. Now, that's a big call, okay, and some of my colleagues will completely disagree, but that's what it feels like at the moment, okay?
Just to remind you, Chris, we are recording this, so yeah. Yeah,
oh God. Okay, well, yep, we're doing two versions, aren't we? That's what you said to me. Anyway, but in seriousness, it feels that actually in the US we're perhaps going to avoid this. This is really quite surprising. And what I want to sort of, first of all, a recession can look different every time. It could be a global financial crisis recession, which is at one point being priced in. We had the banking crisis, banks going bust. Still interest rates increased. Nothing was stopping the central banks. But it looks as if we're going to avoid a recession, or we're at least going to avoid a deep-seated recession in the US and in Europe, which is pretty enormous. Okay, that's pretty enormous. And why this is, why I'm feeling this, and why a lot of people are feeling this, and again, it's not just me saying this, is that good news is now good news. What does that mean? Good news should always be good news. No. So what we've experienced over the last 18 to 24 months is that when we've had good news in the economy, guess what's happened? The market has fallen. Doesn't make any sense. So why has that happened? Well, because traders are trying to say, well, hang on, there's good news, which means the economy is strong, which means bankers are going to increase interest rates further, which is a negative on markets. So everybody's going, oh my God, we don't want good news. We want to pivot. We want bad news. So bad news has meant good news. Okay. Sorry, the slide has gone down there, Ian. I think you might have to put that one back up. So bad news up until recently has meant good news. So when bad data come out, everyone's gone, phew. The banks are in crisis. Fantastic. That's wonderful news, because central bankers will stop increasing interest rates. Completely counterintuitive madness, but that's the world in which I live in. Now, good news equates to good news, because markets are now focused on avoiding a recession because interest rates or inflation, one is believing, has peaked. Okay. Hopefully that was enough sort of commentary on the recession. Now, what sort of effect this has had then on the marketplace is your more sensitive stocks to interest rates have started rallying. In particular, stocks linked to artificial intelligence. Okay, so this is pretty big at the moment. And if we go on to the next slide, Ian. Please, guys, dive in if we've got any questions up until now on what I've said. But if we focus on this next slide, what we've experienced this year is there's only really been one game in town.
Chris, just to jump in, there's been some good questions coming through, so I think we'll leave those to the end, and I'll fire them at you at the end. Thanks.
Can we just cherry pick the easy ones, please? I told you about this. Okay, I'm joking, half joking. Okay, so. Look, we're always sort of, Abbey are always sort of beating us over the head and saying diversification, diversification, diversification. And they're right. When dealing with clients' money, it's all about ensuring diversification is high, costs are low, okay? Transparency and liquidity is high. Transparency, so you know what you're invested in. Liquidity, so you know you can actually sell it. That's really important. It's easy to buy things. It's not so easy to sell things sometimes. Our portfolios that we construct for Abbey Wealth all are sort of high levels of liquidity, transparency, low cost. The reason I'm giving you this because diversification is something that we've been banging the drum about year after year. This year, you've wanted no diversification. Let me explain this, okay? Essentially, there have been around 6 to 7 stocks this year which have performed extremely well in the US tech sector. So this particular chart focuses on each line here, okay, is the monthly return for the last 30 years. So it just looks like a few squiggly lines, but I'm trying to explain this. So over the last 30 years, okay, this focus is on the blue line is the S&P 500 information technology. So basically tech, okay? And then that compares it to the broader market. So if we look at on the right-hand side, it says ChatGPT. This is the revolutionary artificial intelligence app that lots of people are now using, including myself, okay? So ChatGPT, in line with that, what we've seen is a 10% differential in return in May alone. So comparing to the S&P 500, there's actually been the S&P IT or the S&P tech sector has outperformed the broader market by 10% in May alone. That might not sound a huge amount to you, but that's the first time that has happened in 20 years. We're going back to essentially the year 2000. So look, if you go across here, you know, we've got various sort of technological revolutions over the last sort of 30 years. You go to 1990, or 19 sort of mid-90s, you've got the World Wide Web on the left-hand side. Then you've got the BlackBerry. Does anyone remember the BlackBerry? I certainly do. Then, of course, you've got the Google IPO, the iPhone, Facebook. This is just pointing out throughout those 30 years, the catalysts for these sort of tech rallies. We are at that sort of the highest sort of, if you like, bounce that we've experienced for 20 years. So this AI nonsense, the many people might be saying, is pretty real. It's pretty real, okay? And again, if we go on to the next chart here, this is even more sobering, I would say. Yeah, thank you so much. This chart focuses on the AI stocks this year and the effect they've had on the US stock market. So if we look at the broad US stock market, which is what we looked at in the previous chart, which is the S&P 500, that's the main barometer, the 500 largest companies in the US, okay? The S&P 500 this year is up around 8%. On this, it's 8.3%. It's come down a little bit, but it's around 8%. If you strip out 6 AI-related stocks, the S&P 500 would be down 1.4%. Those stocks are, just to let you know, and they are in our portfolio, we're just not 100% invested into them, unfortunately, for this year. Those stocks would be Amazon, Apple, Alphabet, so Alphabet is Google, essentially, Microsoft, Meta is Facebook, and NVIDIA, the chip maker. These particular stocks are all almost like utilities, but they are well positioned to take full advantage of the AI revolution.
And
okay,
Chris, of those 6, would the lion's share of it be NVIDIA anyway?
Would the large share of it be NVIDIA, did you say?
Would the lion's share of that differential be NVIDIA, which is just seemingly gone through the roof this year?
Okay, so, well, actually, great question, Ian. Meta, which is Facebook, we'll call it Facebook, it's a lot easier. Facebook and Meta and NVIDIA both up over 100%. So it's not just them, believe it or not. I mean, Microsoft actually looks much more exciting than Apple for the first time because of the view that they've taken on AI. So these stocks in general, you're right, NVIDIA is the one hitting the headlines and has outperformed absolutely, but Meta is right up there as well, which is Facebook. Meta, of course, or Facebook changed their name to Meta around 18 months ago to sort of demonstrate their positioning towards the metaverse, which is, you know, this sort of VR, AR sort of, you know, AI sort of world that we're moving towards. Okay, but the point that I'm making here, and NVIDIA is a good point. You know, NVIDIA is now at $1 trillion company in the last week of May. So, you know, some investors are feeling nervous about this because what you've got this thin sleeve of certain stocks doing really, really well. So if you're down the pub or in the local coffee shop and you're in those 6 or 7 stocks, you're probably telling everybody, oh, I'm up 100% this year, I'm up 30% this year. But of course, when you invest, it's all about diversification. Those same persons won't, of course, discuss that they were down 30 to 40% or 60% in some instances in 2022. So there's a lot of volatility around these stocks, okay? There is a lot of volatility around the stocks. But this thin sleeve is making certain investors nervous because are we just dependent on the performance of this narrow group of stocks, which of course could mean further volatility ahead if the US does fall into recession, which then alludes to why we are broadly diversified. So, you know, if we go on to the next slide, you know, this AI phenomenon, you know, is here to stay. There's absolutely no doubt about it. But we're not trying to pick those winners either. So how we build portfolios is we will include the index itself. So we will include the NASDAQ, which includes those stocks. We will include the S&P 500, which includes those stocks, because we are not stock pickers. We are simply picking indices and areas and sectors which we think will give the complete and diversified balance to an investor, which might mean from time to time, oh, we're underperforming if you're just out in tech only. But of course, our job is to navigate markets as smoothly as possible. Having said that, the strong surge in AI and tech mega caps historically, and this is the nub here, guys, this chart demonstrates, historically, this is actually a positive because it is expected to eventually then spread to smaller companies. So this particular chart here is some research from a company called BMO Asset Management. And what I would focus here is on the 6-month chart. Essentially, the S&P 500 has averaged a 6.7% gain in the 6 months following mega cap outperformance, right? So what they've done here, they've analysed basically when you've had 5 months of mega cap outperformance, which is what I've experienced or just described, Apple, Nvidia. Once that's happened, after 5 months, what are the chances then for the market catching up? But in this instance, and this is in the S&P 500, which is a US market, in this instance, the average return in the 6 months following is 6.7%. So what I'm trying to say to you is that yes, the rally this year hasn't been broad-based, and that is something to be worried about, or more pertinently, it's something to be prepared about. It's something to diversify around. Because historically, we should see a more broader-based rally, which of course would then, you know, the tide rises all boats, then that's the idea, okay? If we perhaps go on to the next slide here. Thank you very much. Size really does matter, okay? Now, we've heard this before, but after a period of mega cap outperformance, as I touched upon a moment ago, there's actually no reason why the broader market will not catch up after such narrow breadth. So this particular chart focuses on 2 indices. The first indice, the black line, is the Russell 2000. The Russell 2000 is an index in the US, which essentially covers the 2,000 small cap companies, the small companies essentially. And then the Russell 50, the blue line, is the top 50 companies. So this data goes back to 1998, okay? And what it clearly demonstrates is that even though we've experienced now for the last few years upside in the large tech stocks and in the mega cap stocks, over the long term, small stocks have outpaced it. Now, the standard arguments, of course, against investing in large caps apply. You know, it's been long identified that there's a small company effect, and that's mainly due to, well, the first reason is there's less research in the small cap market, so there's more chance of creating or finding bargains, of course. Okay. Also, there's more risk with these small cap stocks, so you have to sort of extend your time horizon here. So I'm not saying to you, look, we need to sort of invest in small cap stocks only. What I am saying to you is that you do need to diversify and avoid the noise, and don't get caught up investing into these mega cap stocks, which we do have within the portfolio. But diversification, of course, is truly key. And if we go on to the next, and this is the last slide, guys, we've been talking for over half hour now, so I bet you're waiting for a break. This is just an anecdotal slide. Apple, okay? So Apple, which is the black line here, is now one company is now larger than the Toronto Stock Exchange, the Russell 2000, which is the 2,000 small companies within the US, and up until recently was larger than the FTSE All Share. The FTSE All Share is the FTSE 100, the FTSE 250. One stock is larger than those markets. which kind of gives you an idea of, again, the tight breadth, the importance of these companies almost becoming utilities, and the effect that they have on the overall marketplace. So when I say that in the S&P 500, they're weighting now on their contribution, not Apple, but those tech stocks that I mentioned in particular, Apple and Amazon and Alphabet, which is Google, Facebook, they constitute over 25% of the weighting of the S&P 500. So again, this is just things to be aware of. And as an investment manager, our job, of course, is to navigate these markets, ensure that that diversification is high. So you certainly get exposure to these areas, but of course you're insulated should these mega caps start to sort of retrace, which over the long term is obviously can be the case. Ian, I think that might be my last slide. So I'm very happy to sort of take a few. Yeah, that's the way we can go.
That was your last. That was your last one.
Slide, yeah. So yeah, very happy to sort of answer questions now. Obviously, only easy questions.
Yes, there were, Chris. Firstly, Chris, thank you very much. Really, really interesting, useful presentation from yourself. I think it's given everyone a bit of food for thought. But some questions have come through. I think we should look at them, maybe rather than cherry picking, just look at them in order. Slides will be available afterwards. Here we are. Question for the end, please. Rather than dwell upon the uncertainties that we all know are associated with inflation, what are the expected trends for investment performance associated with both a rise or a fall in inflation?
Oh, that's from Paul Hearn. I think we should mention Paul's name because that's a really, really good question. So hopefully he's still around and hopefully I answered it well. So, okay, so that's a really good question. First of all, if inflation remains high and we are sort of within a high inflationary environment and interest rates remain high, then the sort of areas that you would expect to perform well, okay, are things such as value. So when I say value, I mean sort of high dividend yielding companies, stocks, such as Berkshire Hathaway and, pharmaceuticals. They're the sort of stocks which tend to do well within a high inflationary environment. So we are positioned that way to sort of, over the sort of coming period, that if inflation remains sticky, as what we've discussed, then you have exposure to income-bearing stocks or high sort of, or value type stocks, low P ratio stocks. Okay, that's one area which would tend to do well. Also, inflationary periods, and some are arguing that it's a myth to an extent in terms of precious metals being an inflation hedge, but we would of course hold on to our sort of our commodity exposure, which we have done. Okay, certainly within the models that we've created. So that's one area. Then falls in inflation, you probably say, if there's considerable falls, and we've experienced AI this year, but growth stocks have done reasonably well this year, because when there's an anticipated falling inflation, then growth stocks do well. Why do growth stocks do well? Well, growth stocks, essentially, their valuations are based on future earnings. So if interest rates are high, then that means that your future earnings are discounted. So when interest rates are rising, growth stocks essentially fall. And I'm being oversimplistic here, but essentially that's what happens. Growth stocks are very sensitive to interest rate rises, so they're very sensitive to the inflation outlook. If inflation falls, interest rates will also then fall, which then means the discounted rate to growth stocks, whose future earnings is their valuation is based on, that will tend to rally. So in the last 18 months, which is where we've been underweight, or up until the last few months really, growth stocks have fallen off cliffs. Some growth stocks have been off 50, 60% in some, the NASDAQ, which is a tech-laden growth stock market. I'm being really simplistic here, but that's the US market, okay? That was down 35% last year, okay, to give you an example. All right, so hopefully that answers, so you position yourself, you'd almost hedge yourself. You have value investing, those typical traditional stocks if inflation stays high, but you've also got growth as well. So you don't just go, I'm all in growth or I'm all in value. You try and get the correct balance in accordance to the risk profile.
Okay. And a question here from another, you may have answered a little. Can you say a little more on how you're positioned based on your interest rate expectations? You feel you've covered that, or anything to add to that?
Look, I mean, the way that we manage money is that we don't take big bets. And that's really boring for lots of investors, but we don't. The way that we build portfolios is focusing on really 4 central planks. The first plank is diversification. All right, you get the diversification right in line with the risk profile of the client, that tends to look after itself over the long term. The next thing, of course, is keeping costs low, which is why we use indices, we use ETFs, exchange traded funds. Third, then, of course, is transparency, understanding what we're invested in. And then the fourth is liquidity, meaning can we sell out when we want to? Can we change the portfolios? They're the 4 central planks of investing for us. Keep things simple as well. Okay, so we then will position ourselves by, of course, then, if you like, going overweight and underweight in particular areas. So last year, we in a terrible year, we had a really, really good year because we were underweight growth stocks. Okay, which was the place to be. We increased our inflation-proofed positions, such as, you know, our inflation-proof, our index-like bonds, for instance. We reduced our traditional bonds because the bond market was on 20%. So that positions ourselves really well. This year, I must say, it's a confusing picture. So we've almost gone for diversification above everything else rather than hanging our hat on anything, and that might change. With having that diversification, as I alluded to earlier, unfortunately, the market is quite dispersed. So there's huge gains in some areas and not so in other areas. So how we position ourselves at the moment is diversified. As boring as that sounds, it's diversified over asset class. So we have in the portfolios equities, bonds, fixed equity bonds, commercial property, commodities, infrastructure. It's over geographical regions, UK, Europe, US, and it's over currencies as well. Okay, so that's how we're positioning ourselves to try and sort of navigate through the confusion.
Perfect. Cheers, Chris. And another one from Paul. Employment rate statistics are in disarray at the moment because the pandemic has caused many to remove themselves from the labour market. How long before the cost of living corrects that effect?
Well, I think yes. I mean, yeah, how long? So, I mean, Paul, we might have to take that one offline. Look, I think, as you rightly say, employment rate statistics are in disarray. And if you looked at the chart that I previously presented, we blocked out the effects of the non-farm payrolls over that period to get a 30-year view. So you are right that they are in disarray. How long before the cost of living corrects that effect? Well, in the UK, as I said earlier, one is still, living on the savings of the pandemic. And I saw a statistic come out earlier, I think it was yesterday, saying, the amount of people, of working age claiming, sickness benefit, for instance, is still, very, very high, very, very high. So, look, I'm not sure. I can't give you a definitive answer and give you any accuracy on that. I think it's a very good question and one that is just continuing to play out in the marketplace.
May I just respond quickly to Chris there, Ian? Hello?
Sorry, I was on mute there, Paul. Please jump in.
Yeah, the reason I asked my question is because you blocked out the, well, let's call it the intense pandemic period, Chris. And comparing the statistics pre-pandemic to the statistics after pandemic really is the reason I asked the question. It's almost an irrelevance, particularly in America, where so many people did take themselves out of the labour market. It's even more. It's better known what numbers took themselves out of the employment market in the UK. This is why everything that's been heralded in the UK as the massive numbers in employment, low unemployment rates. It's almost irrelevant information, to be honest with you. And on savings, on savings.
Sorry, just a second. I think that's why that part was taken out, because it's to take a 30-year view, isn't it? And to sort of point in terms of, where wage growth is or where employment growth is at the moment, which is historically still growing but is slowing.
And on the savings, analysis made at the beginning of the pandemic was that, just looking at the UK, because that's the only one I've got real numbers for, at the beginning of the pandemic, it was calculated that there were enough savings, personal savings, for people globally, not everybody, of course, to survive for 18 months without pay. Now, there's a great deal being said about the amount of money that people saved during the pandemic period. And the fact of the matter is that the majority of people that managed to save are the people that had the savings at the beginning. So there is quite a compelling argument that governments are quite keen to, if you like, maybe not perpetuate the cost of living crisis, but certainly not be too incentivized to get it down, to encourage people to spend the savings, so that that stimulates the economy. And I just wondered if that factor had been considered at all.
Well, I think the point you make there is correct in terms of the ones that, even though if you look from a sort of helicopter view, the in terms of the savings rate and the amount of savings that you allude to, which is over 18 months, but as you point out, the majority of those people that actually received the most amount of money were those that actually didn't need it. So whether that was through sort of corporate entities taking £10,000 grants, or, it was the smart people that knew what to apply for. So that's the first thing. And then the point that so I would agree with that. If you looked at a helicopter view, yeah, loads of money, loads of savings, but unfortunately, it's the people, and I wouldn't maybe not allude to on a working class view, but it's the poorer people, of course, which perhaps didn't have as much access as perhaps those that were in the know. Okay. And the thing about those people in the know, often they're of a demographic whereby they're not spenders, they're savers anyway. Because, of course, because of a variety of reasons.
I agree entirely.
Can I just jump in, Paul? Sorry, I think we've got some other questions as well to ask. Look, we have a really strong relationship with Chris and his team, so I think Chris would be more than happy to speak to you sort of, outside of this meeting, to cover any of your other questions, if that's okay. No worries. Thank you. Chris, sort of just before we sort of start running out of time, a message here, not clear what the final message was on inflation. Is it easing in the short term or long term? Just a quick.
That's a pretty direct comment. Fair play. I think the data, first of all, exactly, not clear on what the final message is. Spot on. It isn't clear. It's still quite noisy. I mean, the data is coming down in the short term. Absolutely. That would point to peak interest rates coming in, certainly within the US pretty soon. That is what the data is pointing to. But the labour market and the employment data is still very noisy. It's still very, very mixed. But I think it would be clear, if you were going to take one message, is that inflation is coming down in the short term. Over the long term, the point that I was making, and I was being a little bit cute here, is that one might argue that the environment that we are in is disinflationary anyway in developed world markets, because, as I pointed to earlier, you have baby boomers coming out of the marketplace. So the employment rate percentage is going to be lower. There's less workforce, and then, of course, you have AI as well, which of course will take further jobs out of that. So the overall trend is what I'm saying. One could argue is actually deflationary, and we will look back on this period in time as nothing more than a spike. That's quite sort of controversial, and perhaps not a house view. But I think that people were more nervous about deflation over the long term ahead of the pandemic than they are nervous about inflation over the long term. That would be my point that I would make.
Chris, question from me, slightly tainted because I did watch one of the Terminator films over the weekend. But what's your long-term view of AI, artificial intelligence? Does it excite you or does it scare you?
Totally excites me and scares me. It's an absolute game changer. One of the points made in the question is that, if you go back to the dot-com bubble, there was loads of companies, which, they rallied because they had a www, World Wide Web address, and of course, it is going to be a job of sifting through the winners and losers. It is a game changer. Of course, there's loads of safety aspects to take into consideration, but the world is on a trajectory whereby there's exponential change and exponential growth, and that is linked to AI, it's linked to automation, it's linked to innovation in general. From an investment perspective, it's difficult to pick winners, which is why, as I say, we invest in the index, we invest in the sector to get broad exposure.
Good. You haven't really mentioned emerging markets in your presentation. Where do they sit in your thoughts, planning?
So we actually, it's a good point you make. We're probably overweight emerging markets. Now, when I say overweight, probably a standard weight would be maybe 10% emerging markets, and then you will have European markets and US markets alongside. US markets could be 50% when you're looking, or even 60% when you're looking at the MSCI World Index. The MSCI World Index is basically a basket of the world, and it gives you all of around 3,500 stocks. So usually 10% of that is emerging markets. We've probably got more emerging market exposure than perhaps the MSCI World. And in fairness, that hasn't really kicked off this year, which is really disappointing. So we were expecting in a zero, when China has opened up, following sort of zero COVID conditions, we were expecting a bigger bounce than we've experienced. We're big buyers long term of India. We're big over China, quite frankly, and have been for the last 10 years. So yeah, I mean, we're bullish on emerging markets. We're overweight emerging markets. It's not really helping us at the minute, quite frankly, because they haven't performed very well this year. But I think, if anything, on a valuation perspective, it's looking even more attractive. Areas in emerging markets that we're looking at, in particular, is emerging market e-commerce. Okay, emerging market e-commerce is an area, again, internet giants like Mercado Libre in Latin America, Alibaba, the valuations and the sort of the demographics of more online users purchasing online means that emerging markets sort of e-commerce companies, from a low base, would be the areas that we're focusing on at the moment within the emerging market space.
Prior to the Ukraine situation, did you have any kind of exposure to Russia anyway?
That's really no, we didn't. No, we didn't. We're not saying that was well flagged, because it wasn't. We just didn't have exposure to those areas. Our sort of emerging market exposure is more focused on it's overweight India and China. Rightly or wrongly at the moment, although India's down around 3% this year, but India as an area, as a country, is somewhere you certainly want to be exposed to. Huge population, young working force, bright. It's the area you want to be in long term. But no, we didn't have any exposure in Russia.
Good. I told you I wouldn't let you get away with it. So let's talk currencies. The pound, the euro, the dollar. What's overvalued? What's undervalued?
Okay, well, I said perhaps more relevant. So why did you do this at the end as well? Really ruin it. So I am not a currency trader. It's really difficult to sort of predict currencies. All I would say is, if you look at, first of all, sterling to euro. Sterling to euro has been trading within a band, within a range. Now that range might feel pretty large, because it is. That range has been on since Brexit, which is 2016, right until now. And the range is 107 to 122. So £1 versus 107 euro to 122. Right? That's the range. We're currently around 116. So we're right in the middle of the range, which means where do you go? Up or down? It's a difficult call. But that is the range to focus on, 107 to 122. So when Brexit was announced, currency plunged to 107. Then it found its feet. Pandemic, again, tested 107, bounced again. Liz Truss, October last year, where did the currency go? 107 again, buyers come in. When it goes to 122, sellers come in and they buy euros. All right. So the point I'm making is that it's range bound, and it's been range bound for 7 years. If you look at the US dollar, the trajectory, and I'm looking at long-term trajectories, currently I think we're 124, 125 sterling to US dollar cable is what we call it. Okay, there's a downward trajectory in terms of pressure versus sterling. So if you go back to 2005, I think off the top of my head, you're $2 to the pound, then you've fallen, you've rallied back up 165. So what that means is you've rallied to a lower high. Then we've fallen again, we've rallied to a lower high again, 140. Then we've rallied to 125. A 125, I say, is a resistance point. And I think, if anything, we might see a further rally, but it doesn't look to be breaking out of that downward trend against the US dollar. So even though we might see further upside and sterling strengthen, there's a downward trend in terms of the strength of US dollar versus GBP. These are just long-term trends, which it's just an idea to focus on, rather than sort of hang your hat on. But yeah, range bound, euro sterling, downward trend or downward pressure, US dollar to GBP.
Perfect. Thanks very much, Chris. I think we're sort of coming to the end now. So on behalf of Abbey Wealth and everyone who attended, I'd like to thank you for taking time out to come and speak to everyone. I think it was a very useful, very interesting presentation. Thank you to everyone for attending. If there are any unanswered questions or anything you would like further elaboration on, please hesitate to get in touch with your Abbey Wealth contact, who's more than happy to pass those questions on to Chris. So on behalf of myself and everyone at Abbey Wealth, I'd like to thank everyone for taking time out of their day to attend today's presentation. Thank you.
Thank you, guys.